Hi everybody, this is Lara with your end of the week video for gold for the trading week ending Friday 20th of March. I was expecting a bounce or sideways consolidation has arrived for gold, prices moving sideways, and it may end next week. It's possible it could end as a deep bounce because this particular market does tend to have its very first sizable second wave correction in a new trend as really deep. The 0.618 Fibonacci ratio is the preferred target at 1602, and when it's done, the downward trend for gold is expected to then resume. Elliott Wave analysis first, classic analysis last. This is still the main wave count. It still has a better fit. It expects that gold is in a huge bear market, that the bear market does not over here, that this was a multi-year interruption to the bear market in the form of a B wave, and it subdivides as a double zigzag. That's a pretty common Elliott wave structure. The first zigzag in the double is labelled cycle W. It's joined by a corrective structure in the opposite direction labelled X, which subdivides as a regular contracting triangle, and that's the only thing that's not absolutely typical about this wave count because X waves are most commonly zigzags, but they can be any corrective structure. And cycle wave Y subdivides very well as a zigzag. If supercycle B is over here, then supercycle C should begin with a 5-wave structure down at all time frames. Let's take a look at this at the daily chart level from the high of supercycle B, this point up here. The first 5 down I'm going to label intermediate wave 1, and we may have minor wave 1 over at this low down here, and minor wave 2 may be just beginning. Minor wave 2 may not move beyond the start of 1. It may end next week. It's also possible it could take a little bit longer, but at this stage I'll look for it to end next week. Let's take a look at the hourly chart of minor wave 2. I have 2 hourly charts, one for the bull count and one for the bear count, and they both work in exactly the same way because they're both looking at an Elliott wave corrective structure. Minor wave 2 could be a double zigzag. First zigzag in the double, labelled minute wave W. The double is joined by a 3 in the opposite direction, labelled X. X waves can be any corrective structure, including a multiple. Not common, but they can be. And here the second zigzag in a double, 5, 3, 5 to be labelled minute wave Y. Minuet B may not move beyond the start of A. If this wave count is invalidated at the hourly chart level, then I would relabel minor wave 2 in the same way I'm labelling intermediate A for the bull count, and not expect that X has moved lower, and it certainly could. At the weekly chart level, this is a bullish wave count. It's still bearish for the midterm. It still expects a huge correction for cycle 4 has just begun. This wave count sees the bear market over for gold here and a bull market beginning. I had previously labelled cycle wave 1 over here, and there was a huge problem with a disproportionate fourth and second wave. I've now considered what if cycle 1 was over here. Now it looks like a 5-wave impulse, but now the problem is in cycle 2. No matter how I label this, I cannot resolve all the problems. It doesn't have as good a fit as the main bearish Elliott wave count, which is the preferred wave count. If cycle 1 is over here, cycle 2 could be a double flat, A, B, C, an expanded flat for primary W, the double joined by a 3 in the opposite direction, and then another flat, A, B, C, for primary Y. The problem is in here. There's what looks like a very obvious triangle up in here, but you can't label a second wave correction with a triangle as its sole corrective structure. And so for this wave count, I have to see what looks like an obvious triangle as a series of overlapping first and second waves. This wave count really does seem forced. What if it is? Let's consider all possibilities. What if gold is still in a bull market? Cycle 3 could have been over here. Cycle 4 may be underway, and it may not move into cycle 1 price territory below the invalidation point. This is a very conservative invalidation point. I would rather it's up here, but let's be more conservative. Let's take a look now at the daily chart level from cycle 3 high here. This point here, cycle wave 4 would most likely unfold as a zigzag. They subdivide 5, 3, 5, and this strong fall in price does fit very well indeed as a 5-wave impulse. And so this wave count now expects a B wave. The bearish wave count expects it's a second wave. any Elliott wave structure. Primary B could unfold as any Elliott wave structure. Minor 2 for the B account can unfold as any structure except a triangle. So if we see a triangle start to unfold, that could tell us that this alternate or bullish wave count is actually correct. That would be interesting. It's most likely to be a zigzag though, and if it's not, it's next likely to be a flat or a combination in that order. Primary B may not move beyond the start of A when A subdivides as a 5 above the invalidation point. The target for cycle 4 for now is for it to correct to the 0.618 Fibonacci ratio of cycle 3. When primary B may be over, I can apply the Fibonacci ratio between A and C to add to the target calculation. At that stage it may change or it may widen to a small zone. At the hourly chart level, I'm still seeing a double zigzag unfolding higher, except here I'm labelling it intermediate wave A, W, X, Y, and I'm allowing here for the possibility that X could continue lower. For this wave count, if intermediate A subdivides as a 3-wave structure, that indicates a flat or a triangle for primary wave B. A combination for primary B would be eliminated because we can't relabel intermediate A as intermediate W of a combination because a multiple may not subdivide into a multiple. Within a multiple, there is a total maximum corrective structures of 3, and that count applies to W, Y, and if there is one, Z. It doesn't include the X waves. They're joining structures in the opposite direction and can be any corrective structure. But W, Y, and Z may only themselves be simple corrective structures. They may not be multiples. To label W, Y, and Z multiples within multiples increases the total number beyond 3 and violates the Elliott wave rule. That is the most commonly broken Elliott wave rule I see in work online purporting or calling itself to be Elliott wave. If you ever see any of that, avoid it. It's worse than useless. It's misleading. When A, if it does complete as a 3, then B, if primary B is a flat, would then need to retrace a minimum 90% the length of A, but if primary B is a triangle, there will be no minimum requirement for B, so the depth of B may start to indicate which Elliott wave structure primary B may be. And remember, this works in exactly the same way for minor wave 2 on that first chart. This week completes another strong downward week, but a fall in volume and a long lower wick on the weekly candlestick are bullish, suggesting a bounce may unfold for gold about here. That's contradicted though by on-balance volume giving us a bearish signal, but it's a weak bearish signal. This line is only just able to be drawn, having the 2 required anchor points. It's not long held and it only has 2 previous tests, so the trend line is weak, which means the signal is weak. For the previous upward trend, ADX reached very extreme. It's now declining, telling us that very extreme trend at the weekly chart level may be over, and there is strength in this downward movement. ATR continues to strongly increase. RSI is in neutral territory. There's plenty of room for price to fall, as is stochastics, and MACD gives us a bearish crossover. At the daily chart level, we were expecting this low. It moved a fair bit below a target I had, and then prices bounced up very strongly. Price has essentially been moving sideways for most of the week. Volume is strongly declining. This looks like a pause within an ongoing downward trend and not the end of the downward trend. Remember, price will not move in a straight line. There will be consolidations and bounces along the way down in a downward trend, and at the daily chart level, ADX is now indicating there is a downward trend. RSI is not oversold, so there is a bit of room for price to fall. It got pretty close though. On balance volume has broken below weak support, giving us a weak bearish signal. We've been over volume. ATR increasing, there is strength in this downward movement. Stochastics is oversold, but when this market trends, that can remain extreme for quite a long period of time. And MACD full ball bearish now. That's all for me this week with your gold analysis. I hope all our members are having a lovely weekend.